Hello and welcome. If you're a SaaS CEO, COO, or CFO gearing up for an IPO, you already know that pricing is pivotal for growth. But today, we're going beyond the usual SaaS metrics. We'll explore how to prepare your software pricing for an IPO from a finance and compliance perspective. This means ensuring your pricing strategy isn't just driving revenue, it's audit ready, transparent, and aligned with accounting standards. We'll cover key areas like ASC 606 compliance, public market reporting expectations, and handling complex scenarios such as multi-element deals, deferred revenue, usage-based pricing, and discounts. Let's dive in. First, align your price model with ASC 606 revenue recognition standards. This is the foundation of IPO-ready financials. ASC 606 provides guidelines for recognizing revenue. In practical terms, every SaaS contract you sign must be evaluated for identifying the contract and performance obligations. What has the customer actually bought? Is it a software subscription, support, services, one-time setup, or a bundle of these? For example, if you sell a package that includes a software license, training, and support, each of those might be a separate obligation. Case in point, Salesforce in the early days sold multi-year subscriptions often bundled with support. They had to clearly separate the subscription service from support in their accounting to recognize revenue properly over time rather than upfront. Number 2, determining and allocating the transaction price. ASC 606 requires that you figure out the total price of the contract and then allocate it across different obligations based on their standalone selling prices. Here is Atlassian's example. Atlassian offers software subscriptions and maintenance. They adopted ASC 606 as of 2017 and ensured that subscription revenue was recognized ratably while any related services were recognized over their service period. This discipline let them report revenue fairly, even as they transitioned customers from on-premise license to cloud subscriptions. Number 3, recognizing revenue once performance is met. Only once you deliver the service can you book the revenue. That's simple, right? For SaaS, that usually means ratably over the subscription terms. Example, monthly revenue for an annual contract or as consumed in a usage model. For instance, Zoom recognizes its subscription revenue over the life of the subscription, monthly, annual, or multi-year. In their IPO filing, Zoom highlighted that a portion of each quarter's revenue came from services sold in prior periods. That means deferred revenue. And that a surge or drop in new sales isn't fully felt in revenue immediately. This is the nature of subscription business. You must track deferred revenue carefully and only recognize it as you deliver service. So get this foundation right, because ASC 606 is where all of this starts. Now let's talk about navigating complex deals, multi-element, deferred revenue, and variable considerations. Okay, so let's first cover multi-element arrangements. If you have deals that include multiple components such as software, services, and upgrades, all of those have to be accounted separately. Investors and auditors want to know that you're not fudging the number by lumping a bundle into one line item. We had touched earlier on allocating transaction price based on standalone value. That's the same way that you would handle bundles. So let's take an example. Think of a Salesforce-like enterprise deal where a customer pays $300K, which includes a 2-year SaaS subscriptions plus $50K of onboarding services. Under ASC 606, Salesforce can't just take $350K and recognize it evenly. They may allocate, say, $280K to the subscription and $70K to services, perhaps recognized as the onboarding is performed. This careful separation was standard practice by the time Salesforce adopted ASC 606, ensuring their multi-element contracts didn't inflate short-term revenue improperly. Alright, the next thing is deferred revenue from upfront billings. Deferred revenue is essentially cash received for services to be delivered in the future. This is a liability on your balance sheet. It's common to use these metrics like billings, current revenue plus remaining performance obligations to communicate the health of your bookings. For example, Salesforce reports this RPO, the value of contracted but unrecognized revenue, to investors. In 2019, Salesforce RPO was about $25.7 billion. That's a big number. You may not be Salesforce's size, but the principle stands. You should demonstrate to investors how much revenue is in the bank for future periods and have airtight records of this. Here's what is to take away. Tailor your communication to your pricing model and ensure that your systems track deferred revenue so precisely that you can slice it by duration, product, or cohort whenever questions arise, and they will. Now let's talk about variable consideration, usage, discounts, and refunds. If any part of pricing involves uncertainty, usage fees, performance bonuses, customer refunds, or flexible discounts, you'll have to plan how to handle that under ASC 606. The standard requires that you estimate variable consideration using either the expected value or most likely amount, but constrain it to avoid booking revenue you might have to reverse later. Here's Zoom's example. Early on, Zoom had a massive influx of free users and monthly subscribers with potentially high churn. They likely use historical data to defer a portion of revenue for expected cancellations or refund requests. By the time of their IPO, this discipline meant that Zoom could handle a 367% year-over-year revenue bump without misreporting. Alright, so now moving on to discounting practices. It's a fact of life, right? Discounting happens. Enterprise deals often involve negotiations. Uncontrolled discounting, however, can wreak havoc, and I've been in consulting engagements where this has been happening. From an accounting angle, heavy discount affect the standalone selling price, SSP. If one customer gets 50% off, is that real or an outlier? Could this introduce the concept of a material? Let's discuss this. A material right is essentially a significant future discount that the customer has earned with their current purchase, which might be treated as a separate performance obligation. Now, Snowflake's finance team provided a great example. Some Snowflake customers negotiated an option to buy more capacity at a discount, but Snowflake concluded those options did not configure a material right because the discounts were within the normal range of pricing. So therefore, you need to standardize your discount tiers and document the approval process. We have to do it for any pricing project I've done. From a compliance perspective, every special deal should go through finance review. And from an investor perspective, you don't want analysts worrying that your Q4 was saved only by massive last-minute discounts. Moving on to public market reporting expectations. There is an element of transparency and storytelling here. The first is GAAP revenue. At IPO, you'll need to present your financials in strict accordance with GAAP. Ensure that revenue streams are clearly broken out. Most SaaS companies will separate out subscription revenue from professional services. Investors will zero in on subscription revenue growth and gross margin. That's what's tangible. If your pricing strategy involves multiple products, tiers, consider whether you should disclose by those categories. Atlassian reports subscription revenue versus maintenance versus other, reflecting its business mix. Consistency here is the most important. Once public, any change in how you recognize or categorize revenue has to be explained. Now we'll talk about forecastability and guidance. In the public market, you'll be expected to provide guidance. Your pricing model heavily influences how predictable revenue is. Subscription models with annual contracts give a fairly solid baseline, and you might know 60-70% of next quarter's revenue upfront because it's already built and sitting in deferred. But when you think about usage-based models, month-to-month models, that makes forecasting harder. Here's what Snowflake did. They had to explain to analysts that because customers have flexibility in consumption and revenue is recognized as used, they did not have visibility into the timing of revenue that many subscription companies have. Instead, Snowflake directs attention to growth in customers and expansions, and indeed they provided conservative forecasts to manage expectations. On the flip side, if you're more subscription-based, leverage that predictability. Perhaps share metrics like renewal rates, multi-year contract mix to bolster confidence that your revenue trajectory is steady. Here's the bottom line. You have to design pricing for predictability even if you have something like usage-based pricing. Finally, disclosure and consistency. When preparing for an IPO, you have to scrutinize the fine print of your contracts and discuss how you will discuss them publicly. Are there revenue terms that are seen as aggressive or unusual? Do you allow customers outside rights to refund or cancel? The investors and SEC will expect you to disclose material terms like refund policies, warranty obligations in the prospectus. Ensure your pricing related terms, refunds, upgrade credits, grace periods are standard and don't raise eyebrows. Now let's talk about audit readiness and internal controls. You don't want surprises. By the time you're public, you'll need to comply with SOX, Sarbanes-Oxley. which means that your internal controls over financial reporting must be solid. The IPO process involves auditors combing through your revenue processes with a fine-tooth comb. There should be a written revenue recognition policy that covers how you handle all the situations we discussed earlier: subscription, services, multi-element deals, usage fees, discounts, refunds, so on. Internal controls should ensure the policies are followed on every deal. Whether it's a $1,000 deal or a 1 million customer, the process of booking it should require the same rigor in your systems. You have to build an internal audit and SOX compliance mindset. Many late-stage private companies bring in internal auditors or SOX consultants about a year before IPO. Their goal is to test your controls and identify gaps. It's wise to embrace this. They will check things like, do you have proper segregation of duties? Is the person who enters a contract in the system the same as the one who approves RevRec? Should not be. Are there changes to pricing or product catalog in your billing system reviewed and logged so that no rogue product and incorrect revenue treatments get added? Are you limiting access to systems so that only the authorized staff can issue credits or modify a contract? All of these fall under general internal controls and IT controls, and they affect revenue reporting integrity. Now let's talk about strengthening quote-to-cash systems for IPO maturity. It's a favorite topic of mine. We've built CPQ systems before. The quote-to-cash process from initial quote through contract, billing, cash collection, and RevRec is the engine room that will be stress tested as you go public. As the company grows, manual processes that worked with 50 customers will break with 5,000. Automate as much of the C2C workflow as possible. This means get a CPQ system in. It's not going to be easy, but you need it. And that's going to be very helpful for the ASC 606 compliance requirement. Automation ensures that when a deal is closed in CRM, the data flows correctly into billing and then to the revenue schedule with minimal human intervention. Ensure that your systems can produce reports that tie out the entire revenue cycle. And you'll need to test the scenarios. As you prepare for IPO, consider performing an integrated test. Select a handful of contracts and walk through the entire process: quote approval, contract signature, invoice generation, revenue schedule creation, and cash collection. Bring in the auditors or advisors to observe. If everything flows and controls kick in where they should, investors don't really see this directly, but any leak or blockage would certainly show up in the numbers, which is the last thing you want. Here's your IPO mandate. Let's reinforce the big picture. Designing pricing for IPO means balancing two critical objectives: fueling growth and ensuring transparency with control. The best SaaS companies manage to do both. They use pricing as a strategic weapon to win market share and as a stabilizing force to produce reliable, auditable revenue streams. Ultimately, preparing software pricing for IPO is all about confidence. Confidence for auditors that your numbers are right. Confidence for finance team that